Why does the wealth of the top 1% seem to grow on autopilot, while average earners watch their savings slowly evaporate? Crossing the $100,000 threshold triggers a specific mathematical tipping point. At this stage, the interest your money earns begins to outpace the amount you can realistically save month to month. Your money starts doing the heavy lifting. But if you leave that 100 grand sitting in a traditional bank savings account, you guarantee a loss. Because of inflation, the purchasing power of that cash will slowly erode away year after year. To actually protect that capital and systematically multiply it by 10, you need a layered strategy. Think of this as the millionaire's hierarchy. You cannot bridge the gap to $1 million by simply clocking more overtime. True wealth is built by letting the mechanics of compounding take over, replacing your physical labor with financial leverage. The broad, stable foundation of this hierarchy is the engine that drives your growth. It works by generating returns through owning a microscopic fraction of the entire economy, all at once. Instead of trying to guess which individual company will win, you use an index fund. You buy tiny slivers of hundreds of top companies simultaneously, completely removing the danger of picking a single bad stock. Investing $100,000 in a broad market index naturally compounds to $1 million over 3 decades, but management fees threaten this timeline. Paying just 1% a year drastically reduces your total, so use low-cost providers. Time and rock-bottom fees are the absolute requirements for this foundational level. However, a simple engine built entirely on index funds leaves you completely exposed to severe and sudden market crashes. When panic hits the markets, psychological pressure often forces unprotected investors to sell their index funds at a steep loss, just to stop the bleeding. This requires asset allocation. By adding bonds, fixed income loans made to governments or corporations, you create financial shock absorbers. When the stock market drops, bonds tend to hold their value and stabilize your portfolio. Mechanically, you divide your 100 grand into 2 separate piles. One goes into stocks for aggressive growth, and the other goes into bonds for safety. Once you insulate yourself from market drops, you have to face the next invisible threat to your compounding returns: capital gains taxes. Every time you sell a winning asset, the IRS takes a cut. To prevent this, you place your investments inside tax-advantaged accounts, like 401ks and Roth IRAs. These provide a legal shield, protecting your investment growth from annual taxation. You can push this defense even further with tax loss harvesting. This involves deliberately selling underperforming assets to legally cancel out the tax liability generated by your winning investments. Proper asset allocation and tax shielding do not accelerate your growth. They are the strict mathematical requirements that guarantee you actually get to keep the $1 million your engine generates. At the very peak of the hierarchy, we find alternative investments. These include private equity, commercial real estate, and direct business acquisitions. The primary allure here is speed. These assets have the unique potential to drastically compress that 30-year timeline required to reach $1 million. But that speed requires a complex trade-off known as illiquidity. Your cash is locked away in physical property or private contracts, meaning you cannot quickly access it if you face a sudden emergency. There is also a severe risk of total capital loss. Because these assets are often unregulated, highly leveraged, or heavily concentrated, a bad deal can wipe out your investment entirely. Because of that danger, financial advisors enforce a strict 20% limit rule. Capping your alternative exposure ensures your core $100,000 is never fully wiped out. Alternative investments are powerful accelerators, but they are entirely optional, and they are only effective if your foundational index funds and tax shields are already firmly in place. Climbing this hierarchy serves a highly specific end goal. For many, it is the foundation of the FIRE movement: financial independence, retire early. Cultural myths suggest building $1 million net worth as about purchasing luxury status symbols, but rapid lifestyle inflation destroys compounding wealth faster than a market crash. True financial independence is the purchase of options. It buys you the ability to change careers, withstand economic disruptions, or retire early on your own terms. Reaching that finish line requires 2 final behavioral rules: ruthlessly automating your monthly investments and strictly avoiding lifestyle creep as your income grows. Transforming $100,000 into $1 million is not a lottery ticket. It is the completely predictable mathematical outcome of disciplined compounding, protected assets, and intentional lifestyle choices over time.